Well, here we are. Good evening and welcome to this live stream event on the 7th of September 2021. Martin North from Digital Finance Analytics here. Great to have you on board and nice to see so many people on already. We've got a good audience and hopefully more will arrive. As with all of these things, people tend to arrive a bit late, but that's okay. We'll get going anyway. A couple of interesting comments on my little demonstration of some of the things going on behind the scenes from Cookie Boy. Not free Martins, no. Thank you for that. Yeah, well, you know. Adam says, was it necessary? No, it wasn't necessary, but I quite like playing with the technology just occasionally. You know, it's good to share a little bit of it. Anyway, the main thing, of course, is the content rather than the platform and the mechanisms. So let's get on with that. And to do that, let me just switch over to this particular view first. So this is what we're going to do tonight. Very much go through our stress and household survey information. There's a lot to see there. And as normal, we start with just quickly the running order, this introduction. I'll touch on the house rules as normal. I'll talk about the models, a few key slides. Then there'll be some questions and answers. That's the main part of the show, and you'll be able to ask any questions you like. I'll try and answer them. If I can't answer them, I'll let you know. And then we'll sign off about an hour and a half probably, typically, for this sort of show. And just in terms of the house rules, as always, this isn't financial advice. I'm not a financial advisor. I'm just talking generally about my analysis and my surveys. If you need direct financial advice, then it's very important to go find a financial advisor rather than try and work it off the back of what I say. It's just general analysis. Also, do please play nice in the chat room. Very important that there are no racial slurs. I do moderate the stream, and if necessary, I will turn people off. Generally, the audience is pretty well behaved, and I do encourage the conversation in the chat. I think it's an important part of the community. This is at the 7th of September 2021 for those watching in replay. If you want to get my attention or ask a question, use @Walk the World. That means it'll get sort of shouted out at me in the chat, and there's more chance of it then getting recognised and answered. And also I've enabled Super Chat, which enables you to get your question top of the queue if you'd like to do that. But also, if you want to make a contribution to help run the show, it will be greatly received and beneficially received too. We do need a bit of support for what we do. We don't do this for profit. We do it simply because we think it's a really important thing we're talking about, and hopefully we're helping people make better financial decisions. That's what it's all about. Anyhow, with that, let's just quickly recap on my models. This is for those who've not joined us before. We do a lot of modelling, basically around households and what's going on in the minds of households. And you can see here that we pull information from our various surveys and other sources of information, including industry information on RBA and APRA data, put into our core market model, and that then feeds everything we do from client assignments through to the specific industry reports, through to the blog and everything that we talk about on this channel. So the point is, it's based on real data from real households. And that's really important because what it means is there is a lot of immediacy about what we have here. Essentially, the data comes in each week. We can also slice and dice the information by different segments, different geographies, and even different property statuses, which means that we can look at it from different ways. It's a Rubik's Cube, as I often say. You can look at it however you want. And that then leads us also to be able to form some views about where things might be running. So we look at scenarios, we'll touch on those a bit later. And also using that insane information from mortgage stress and the price trajectory and the buying and selling intentions and the migration statistics and the economics, CPI, etc. All of that goes into the core market model. And then that gives us a view also of what may be happening ahead in terms of price moves. And that's something else that we'll touch on as we go through the discussion this evening. And on that front, we do also offer a one-to-one survey. So if people want to have a conversation about a particular suburb and get into a lot of detail about what's going on and what the trends may be, we do offer that service. And that essentially means that it's individual conversation. It's not specific financial advice, but I can go down to a specific suburb and look at the underlying trends. I can look at stress information. I can look at some of the other data that's there, and even things like planning regs and flooding and those sorts of things, crime, quite detailed. And typically a conversation about an hour. There is a cost involved, and we have a bit of a waiting list, 3 to 5 weeks at the moment, with a lot of people wanting those conversations, particularly now. But if you are interested, go to the blog and contact me via the blog if you'd like to pursue that. Anyhow, with that, now we need to talk about the RBA, because the RBA has come up with yet another, not a statement exactly, it's a short summary of their discussion today. And they said, firstly, at the meeting, we're going to maintain the cash rate at 10 basis points and the interest rate on exchange settlement balances at 0, so no change there. We're going to maintain the target of 10 basis points on the Aussie government bond, no change there. But they did say they were going to tailor back the purchases from 5 billion to 4 billion a week, but continue the purchases at that rate until at least mid-February 2022. So what's interesting about that is that on one hand they're saying we're going to do a bit of tapering, but then we're going to actually continue to to buy bonds at a lower level. And in fact, the net sum of all that is they've essentially signed up to putting another 13 billion into the economy through quantitative easing. That's what they've actually said. So interestingly, some players like Westpac were asking for a bigger injection, others less so. So that's quite an interesting position to come to. And it'll be interesting to see how the markets react ahead and over the next few days, I guess. And then if we look a bit further, what they said, prior to the Delta outbreak, the Australian economy was very momentum driven. GDP was picking up 0.7% in the June quarter, nearly 10% over the year. Business investment was picking up. Labour market strengthened. Unemployment rate was below 5%. Job vacancies were at a high level. In other words, everything in the garden was wonderful. Then they said the recovery in the Australian economy has been interrupted by the Delta outbreak and the associated restrictions on activity. GDP is expected to decline materially in the September quarter, and the unemployment rate will move higher over coming months. While the outbreak is affecting most parts of the economy, the impact is uneven. Some areas facing very difficult conditions, while others are continuing to grow strongly. Yeah, it is a patchwork, no doubt about that. And they said this setback to the economic expansion is expected to be only temporary. Delta outbreak is expected to delay but not derail the recovery. As vaccination rates increase further and restrictions are eased, the economy should bounce back. There is, however, uncertainty about the timing and pace of this bounce back, and it's likely to be slower than earlier in the year. Much of it will depend on the health situation and the easing of restrictions on activity. And they've got this central scenario where the economy will be growing again in the December quarter and is expected to back up to where it was pre-Delta path in the second half of next year. In other words, a bit of a blip, nothing to see really. And they said, notwithstanding the strong economic and labour market, pre-Delta wage and price pressures remain subdued. And over the year, the wage price index was just 1.7%. So not much news on the wage front. And they went on to say, house prices are continuing to rise, although turnover has declined in some markets. There's a bit of a movement by both owner-occupiers and investors, and the bank monitoring trends in borrowing carefully. And they underscored lending standards need to be maintained. Heard that before somewhere, I think. And they also said very accommodative financial conditions will continue to support the recovery. Borrowing rates are at record lows. Sovereign borrowing yields at very low levels. And frankly, this is all about keeping government debt very, very low, it seems to me. Although, of course, they say providing welcome assistance to supporting household and business balance sheets. Yeah, I wonder how much of that really is happening. And then they went on to say they're going to extend the bond purchase of 4 billion a week until at least February. Reflects the delay. They'll review the bond purchase program in the light of economic conditions. Those bond purchases, together with low levels of cash rate and the yield target and the funding, will effectively provide ongoing support to the economy, and they're committed to maintaining highly supportive monetary conditions. It will not increase the cash rate until actual inflation is sustainable within 2 to 3%, and that is not likely to happen before 2024. and they need a tighter labour market to be able to make all of that happen. So, in a nutshell, not a lot to see from the RBA. They really are not biting at some of the downturns, which I find a bit surprising. I think they're understating some of the issues in the economy, as I'll show you in some later slides. And fascinatingly, this was actually sort of the lower end of expectations. So Westpac was definitely arguing for a significant increase in quantitative easing. Some of the other banks were actually on the other side of that fence. And in fact, I made a show earlier today where I went through the position of NAB and ANZ and Macquarie as well as Westpac, because it is quite interesting just looking at the different perspectives that people have. Anyhow, let me move on and talk about a few other things, and then I'll go into the stress. And just to explain, I'm not looking at the chat really significantly at the moment. So if you've got a key question you want to ask me, hold off, ask me a bit later. But I will come back to the chat once I've gone through some of these slides. The reason I think these slides are important is because it helps to give a bit of context for some of the discussion. And I think we have to talk about Evergrande. Now, Evergrande, as you may know, is one of China's biggest property developers. It's on the brink of collapse, and that could mean bad news for Australia, as news.com.au reported. The company owes hundreds of billions of dollars, creditors are beating down the doors, and the property developer has been in a death spiral. This week they warned that it could default on the substantial debt. It's got about $408 billion in total liabilities, and the group has risks of default on borrowing in cases of litigation. Now, it's responded by halting projects, renewing borrowings and disposing of equity and assets, and the cash-strapped company will delay payments to suppliers. And the substantial share price dropped, down 72% in Hong Kong over the year. And then, if you look to the next comment, well, this came out. Bonds issued by indebted developer China Evergrande Group slumped on Monday after a ratings downgrade led to restrictions on their use as collateral, prompting China's stock exchange to halt trade. The Shanghai Stock Exchange said in a statement that it had temporarily suspended trading in China Evergrande Group's 6.98% July 2022 corporate bond following abnormal fluctuations. And then there was this from the Financial Review saying foreign investors are becoming increasingly fretful that Beijing is preparing to separate out Evergrande's real estate arm, leaving them with major losses. So the question is, will the Chinese get bailed out? Will they bail out part of it, all of it? Or will the second largest construction edifice in China end up falling over? And if it does, that could be quite significant. So this is one to watch. It's too soon to know precisely how this is going to play out. But I'd also make the point that this, to my mind, is a very good tip of the iceberg conversation, right? I think there are a lot of other companies around the place, particularly in China, that are also in some significant financial difficulties at the moment. So watch this space. Because if the construction sector in China continues to go sideways, less demand for steel, and of course, iron ore price is already on the way down. Not good. Now, if I then go on to something else to talk about, here we got more data today about the dwelling approvals in July, and the ABS said the number of dwelling approvals fell 8.6% in July. Private sector houses fell 5.8%, following a 10.1% fall in June, and private sector excluding houses, in other words units, were down 12.3%. So dwelling approvals off a cliff, and that of course is after the home builder initiative folded up. So the question which you probably should be thinking is, well, will the government do something else to try and inject more momentum into the dwelling approvals of new property? Maybe they will, because at the moment it's definitely going the wrong way. And just continuing that theme for a bit longer, APRA released their mortgage lending statistics today, the quarterly ones, and they showed that mortgage credit rose by 1.8% over the quarter and 4.7% for the year. They said owner-occupied credit expanded by 8.7% over the year and investment credit just 0.1%, although they do think it might pick up over coming quarters. And they said the overall LVR profile of ADIs, housing lending remains strong. The share of residential mortgages outstanding with LVRs greater or equal to 90% continues to decrease incrementally from 4.7% to 4.6%. Very small amount of movement, but on a bigger number. So in absolute terms, this means that more loans are actually being issued at high loan-to-value ratios. That's a problem, as we'll see in a second. Now, if we then go on and just look at some of the other data, they also highlighted the significant rise in new mortgage lending. New residential mortgage lending increased by 22.8% in the June quarter, partly reflective of seasonally lower levels of lending in the March quarter. Well, I suppose that's one way of trying to explain it. New residential mortgage lending increased by 40.5% compared to the June quarter 2020. That's probably a base effect. Lending to owner-occupiers continued to grow more rapidly, and lending to investors increasing by 23.9% and 19.3% respectively. This result is consistent with favourable borrowing conditions, including historically low interest rate environment and government measures supporting first-home buyers, along with strong performance in the housing market. Yep, a lot of new mortgage lending. And it's worth reflecting on that in the context of a lot of people are paying down their mortgages, particularly those who've had them for some time. So we're seeing this rotation away from a lot of older mortgages being paid down and more new mortgages coming in at bigger levels. And the average first buyer mortgage is 15%, 18% higher than it was a year ago. Not necessarily very positive. Mind you, of course, APRA is not trying to tell the complete story. They're trying to give a specific spin on the data, in my view. Now, the LVRs are down a bit, they said. New lending at higher loan-to-value ratios are down, decreased to 8.6% in June from 10.4%. 8.6% is still quite high. But again, let me make the point. This is on a much larger tranche of mortgages being written. So whilst the proportion may be going down, the actual quantum, the real amount of lending that's being done at high loan-to-value ratios is continuing to rise. And that last point of theirs, that the share of new lending at high LVRs continues to remain below levels seen over the past decade, is simply because there was a stupid amount of lending at very high loan-to-value ratios early in the decade. So that doesn't actually give you any confidence at all, in my view, of anything. So again, I believe that in the public domain, at least, APRA is understating the loan-to-value ratio story. It's a worry, because that is going to cause problems later, in my view. Now, debt-to-income ratios, they are up. They had to admit, they had to come clean on that. They had to say the proportion of new residential mortgage loans with high debt-to-income ratios rose over the June quarter, reflecting increased house prices and continued low interest rates. The share of new loans with debt-to-income over 6 times grew by 2.8% to 21.9% of new lending in the June quarter, the largest increase since the collection of this data. Now, just think about that. So we have more and more people who are getting mortgages at higher multiples of debt to income. Now, the argument, of course, is, well, the interest rates are low, so the serviceability is easier. But they still have to repay that mortgage at some point down the track. And if you look at what's going on here, compared with, for example, in the UK, where they got caps on what proportion of high debt-to-income ratio lending can be done, you can see that the lending standards here are way, way looser. And again, this is just another indication of the mortgage sector just going out of control and the regulators still asleep at the wheel. Seen it before, but this is a real wake-up call in my mind. They are not doing sufficient to control the risks that are growing in the system. Maybe no surprise, of course, because APRA tends to look at it from the big bank's point of view rather than from anywhere else. And they said, look, stable asset quality, no problem, nothing to see here. Asset quality in residential mortgage lending remains stable, with non-performing loan ratios consistent with the pre-pandemic levels. And the non-performing loan ratio decreased slightly from 1.06 to 1.04. Investment loans have slightly higher non-performing loan ratios, decreasing from 1.1 to 1.07. While owner-occupied non-performing loans fell from 1.04 to 1.02. Very, very small movements. But they said the outlook for NPLs remains uncertain, given the lockdowns. And, of course, the data, as they say, is unlikely to represent what's going on in the current COVID environment. And remember, we've got lots of banks now giving leeway to people because they can't afford to make mortgage repayments. Those loans are not classed as non-performing loans. So this statistic is not fully representative of the current state of play in the market. And we won't really get a read until later in the year when those loans have to be either reclassified as non-performing or be put back in good order. So we really don't know precisely the state of the bank's books at the moment. I think that the situation is significantly worse than the official statistics from APRA suggests, but we'll see. Now, Roy Morgan data came out today, and they just show that the unemployment and underemployment rate combined was a small 17.7%. That's compared to the 12.9% data from the ABS. Now, Roy Morgan calculates it differently. We've discussed this before. And interestingly, the unemployment rate was 9.5% compared with 4.6%. Very significant difference. Now, the other point they make is that there are a lot of people now not even looking for work. So they're out of effectively the job search. And that means they're not classed as unemployed. And that's a problem. That's why the numbers have actually gone down. They said there was a decrease in part-time employment, down by 46,000, and full-time employed dropped 111,000 from July. In other words, less people looking, particularly with COVID. So these numbers, which I think are closer to the truth and would certainly be much more accurate, aligned to what I'm seeing in my data, is a very significant concern. And it just, I think, casts a big question mark over the quality of the ABS statistics. Also, they've reported, Roy Morgan, that confidence was down. Consumer confidence declined 1.8% last week. Despite rising vaccination rates, sentiment dropped in Sydney, Melbourne and Brisbane. Adelaide and Perth lifted slightly. And the most notable thing in this week's release was the jump in inflation expectations. It's at the highest level in almost 3 years. Now, the weekly reading can be volatile, but nevertheless, this is a very significant issue. So a lot of people are now getting twitchy about future inflation rates. And that's, I think, a very important issue to recognise. A lot of people are feeling that inflation is a lot higher than the official statistics. And that's because for most people, inflation is much higher than the official statistics. Not least, of course, because housing costs are not included, and a lot of the other data is partial. So it is interesting it's coming through now in some of those confidence statistics. And yeah, as you know, as I've discussed before, confidence is actually very important because it does lead to people spending more or spending less. If confidence is degrading, people save more and spend less. The reverse is also true. So this is a very important forward-leading indicator in my view. It'll be interesting to see whether it turns around later in the year or whether we see confidence continuing to grind down. And by the way, confidence in some other countries around the world is also degrading, again, thanks to Delta. Now, let me just move on to the mortgage stress data. And just to explain, mortgage stress is defined, as I always define it, as cash in, cash out. So from our surveys, are households paying out more than they're actually receiving in terms of income? Sure, they can pull down on deposits or put stuff on credit, but if that continues, eventually they get into a difficulty. So it's a cash flow measure of stress. It's not a set percentage of income. And we look at it in the round, not just the mortgage payment or the rental payment, but all their outgoings, all their income. Is there sufficient income coming in to cover all the costs, including housing costs? That's the key question. And the data showed that, in fact, in August, well, it went up again. So we're now at 42.1% of households in mortgage stress. That's the highest it's ever been. And just by comparison, back in February 2020, before COVID arrived, it was at 32.9%. So we've now got pretty much 10% more households in difficulty thanks to the COVID episode. And the RBA data, the household debt to income ratio data, which is delayed several months, is at 180.9. You can see it's come back a little. That's because, of course, the people paying down debt and also some of the other factors that we discussed earlier, but it's beginning to rise again now, so that's a bit of a concern. But if we then go into a bit more detail, I'm going to start with the August summary data by state. And what I've done here is I've highlighted in yellow the numbers that are higher than last month, and in bluey, or is it grey? I'm colourblind, so whatever colour that is, where it's actually improved. And so you can see that from a mortgage stress perspective, and I can just compare the July numbers with the August numbers. The first thing to highlight is that we've got 1.55 million in mortgage stress last month. That's gone up to 1.558. So another 8,000 have actually joined the ranks. And as a result of that, we've got a risk rise of stress in New South Wales, in Queensland, in South Australia, in Western Australia, and the total is at 42.07. There was a slight decline in Tasmania, down from 56.5. It was up last time, but it's now come back down. And also, you can see there that in the ACT, there's very little change. Rental stress is also one I watch very closely, and we've got 1.963 million households in rental stress, compared with 1.944. So 944 last time, 963, but it's actually moved slightly down in terms of the percentage. That's because there are more people renting. So one of the factors we've seen recently is some people giving up on owning property and moving into rental property. So we've actually got more people in renting than previously. Now, if you look across the states, there was a rise in rental stress in the ACT, in Queensland, and there was a small fall in New South Wales, South Australia, Tasmania, Victoria. And the overall percentage is 38.04 compared with 38.83 last time. So that's one of those really interesting movements that you've really got to get into detail to understand precisely why it's happening. Then if you look at investor stress, so these are property investors, and there you can see that there was a rise in ACT, Queensland, South Australia, Tasmania, a slight fall in Western Australia. That's because there's been a significant rise in rentals in some areas of Western Australia. But still, we've got 25%, or 805,000 stressed investors. And then if you look at financial stress, which is the aggregate measure, so this is measuring all the different types of households with all the different types of stress. And overall, we've got 39.1% of households. And interestingly, there was a little bit of a rise in Queensland and South Australia this time, a slight easing in Tasmania and Victoria, and a slight easing in Western Australia as well. So that's where we are on that particular metric. I can also look at it quickly by the segments. And, there are some continuing stories here. Young growing families continue to languish in mortgage stress, a lot of first-time buyers, of course, and a lot of those are also in rental stress as well, but also young affluents. The young affluents in particular are actually very significantly exposed to rental stress and also to investor stress. In fact, young affluents have the highest proportion of investor stress, even higher than the exclusive professionals, which is the other group with multiple properties. Many young affluent people actually don't know what they're getting into with property investment, and they end up, I think, in quite difficult situations. Quite a few of them have just bought a high-rise or a few high-rises without fully understanding the economics of what they're doing. And unfortunately, that's turning out to yield significant stress. But you can also see that some of the other segments are also up against it too. And it's a bit like, wherever you look, you can see pockets of difficulty. Now, if I then just continue that conversation a bit further and look at some of the particular postcodes, this is just sorting by the number of households in mortgage stress. So the postcode this time with the highest level of stress is around Liverpool, Warwick Farm. Then we go down to Narre Warren in Victoria, 3805. And then we go to Victorian postcode Berwick and Huckaway. And then we go to Western Australia, to places like Tapping and Wanneroo. Come back to Victoria, Pakenham, Tarneit, Roxburgh Park, Ballarat East, Cranbourne, Sydenham, Dermont, I should say, the Point Cook, Werribee, places like that, and on it goes. You may recognise some of those postcodes. Quite a few of those postcodes are where the highest levels of COVID infections are actually currently in train. And there's a very strong correlation between postcodes where there's a lot of stress and postcodes where there is a lot of COVID. It's partly because many people are being forced to go out to work simply because they've got to try and pay those mortgages. There are also bigger families quite often, and bigger families tend to actually spread the virus more. And they tend also to be socially disadvantaged relative to some other areas too. All of those things are in play. So there is a real issue here in terms of what's going on. And if we then just move on and look at rental stress, bit of an interesting story there. We've got this south coast area which has been consistently in trouble from Jervis Bay from a rental perspective. And that was even as far back as the bushfires previously. But then we go to Chipping Norton, Liverpool, places like that. West Gosford, up on the north, mid-north, on the central coast, I should say. There's some real pain going on there. And by the way, there's some COVID happening up there now. And then we go to places like Lethbridge Park and Mount Druitt. Then we go to close in to Sydney, like the Rocks, places like that, Haymarket, Millers Point, Dawes Point. Very interesting there. A lot of those are high-rise renters who are really under the gun at the moment. And so it goes on. And again, I'll highlight Point Cook, Werribee, Dermont in Victoria, again, where there's a lot of COVID, as well as places like Surfers Paradise in Queensland and Bondi in New South Wales. Quite a few of the people in Bondi are actually in those newish apartments that are actually very expensive. And even some more affluent areas like Elizabeth Bay and Potts Point, again, a high proportion of people in financial flow difficulty. And if we then quickly look at stressed investors, well, it's a bit like, Westmead, Wentworthville, spot the commonality. Quite a few people in those high growth corridors are in difficulty now. Also, Surfers Paradise, a lot of people went up, thought they'd buy investment properties up in there and are finding it's not working out quite as they expected. And then we've got another Queensland postcode. And then we go to Western Australia, like Mandurah, it's still there. A lot of property investors in Mandurah are still underwater. And then we come to Surrey Hills, Darlinghurst, Southport up in Queensland, Melbourne, 3,000 in Victoria. A lot of people there, of course, with a high rise. South Yarra, ditto, and places up in Queensland too. And if you come down, you'll see places like DY on the list there too, as well as South Bank in Victoria. So again, a patchwork quilt. Very interesting to see those patchworks continue to develop. And again, I'd highlight some of the correlations with the COVID migration and the COVID infections. And finally, the financial stress overall. This is the the summation, if you like. The worst postcode at the moment for financial stress is Liverpool, Warwick Farm, Mount Pritchard, 2170. Then we go to the centre of Melbourne. And then we go to places like Mount Druitt and Lethbridge Park, 2770. And then Point Cook, Werribee, Dermot, 3030. And then Tarneit, Hoppers Crossing. And the Cranbourne and Fountain Gate, Narrow Warren. And then we go up to regional areas like South Tamworth, as well as the Central Coast around Gosford. So you can begin to see some quite significant footprints. And interestingly, I'll make the point here that a lot of those are those high growth corridors where there's been a lot of new building still going on. A lot of people bought big property mortgages with average size incomes are now struggling. So there you go. That's the story with regard to stress. And just to round off my conversation with regards to mortgage stress, I will just bring up the stress maps so that you can see some of the recent analysis that I've done. So this is the stress map for Sydney. And here you can see I've coded the number of mortgage-stressed households, with the bluey ones the lowest counts and the orangey-reddy ones the highest counts. And you can see immediately that places like Campbelltown, Fairfield, Liverpool, around there, are actually in some difficulty. So Western Sydney, but if you actually drill in, you can also see that there are some other areas where there are also a few different problems. These maps, if you were to overlay COVID, you'd find they were somewhat similar. Now, if I then look at 3,000, just to jump straight there, okay, and now if we just pull out from the centre of Melbourne, bearing in mind that the orangey ones are the ones where there are more issues, you can see that closer in, mortgage stress isn't too bad, but as you come out and you begin to see some of those stressed areas, you can see the city of Wyndham is showing up quite early on there as an issue. No surprise, bearing in mind what I said earlier on. And then you can see some of those other postcodes down here around Casey, the other side of Dandenong. And as you pull out, you can see a somewhat similar story. And again, if you were to do a trace of where COVID was actually rampant, there would be a very high correlation. And I will just go to this one here. Okay, I'm now going over to Western Australia, to Perth. And again, mortgage stress, well, it's not looking too bad close in, but as you begin to pull away, you begin to see again those numbers rising. South Perth, coming south, not looking too good. Wanneroo up around there continues to be a problem, again a high growth corridor. And in fact, if you pull right out, you can see that some of those areas to the south and the north of Perth are actually in considerable difficulty. Now, if I then pull up the rental stress for Sydney and begin to pull out again, you can see that, as I highlighted earlier on, there's a lot of rental stress close into the city, and there's also, interestingly, some footprint in places like Bondi. A lot of those are younger people in property that probably is relatively expensive and frankly is difficult to service when the incomes are actually under so much compression as they are. But as you pull out, you can also see a somewhat similar story there, with again Western Sydney showing some of the issues. Now, if you could sort of bear that in mind, so you can see around Parramatta, Blacktown, Liverpool, Campbelltown, a lot of rental stress there. And if you compare that with 4,000, we'll go up to Brisbane now. This is rental stress in Brisbane. And, you know, the story in Brisbane is not as severe, but there are a few pockets now beginning to emerge where rental stress is beginning to be a bit more of an issue. Some close into the city, and as you pull further out, you can see that there are a few other areas too, which begins to sort of highlight that, well, maybe it's not quite as straightforward. If you come out of the Gold Coast, not massive, but enough to be a bit of a concern. And so it goes on. And if you go inland a bit, you can see Ipswich and around there, and Toowoomba are places where there are significant issues. So I think that's probably enough. If you want me to show other maps, happy to do that. But I will just do this now. Let's go back to my slideshow. Because I just want to touch on our scenarios. Scenarios are a way of trying to talk about the future. They are just different illustrations of what may happen. I have updated things a little bit. I've updated the RBA baseline based on what they've said. So I've reduced the expectation of house price growth next year. I still think it's likely to be 15 to 25% over the next 3 years, but it was 35%, so not as high. The others are pretty much the same. I think the base case that I run is that there will be some further movements in prices, particularly for houses, units less so, but there will be some areas where prices will fall over the next 2 or 3 years. The losses will be contained. Mortgage stress will come back a bit if, in fact, everything gets back to where the RBA thinks it's going to. I don't think we're going to get 32%, but I think we could get 37% over the next 3 years. But if any of these other scenarios play out where you have more longer-term crunches, so the virus continues to morph. There's the Mu version, for example, which emerged out of Colombia and is now looking like a troublesome one as well. Or if you get really big multi-wave disruptions, then there are more downsides and up. But look, my base case is a little bit of upside for some and some downside for others. So that's where all the scenarios are at the moment. Okay, well, there you go. That was a little bit of a tour around my analysis. I hope you found that useful. Let me just go back and pick up a few of the comments and I'll see what people have been saying. And while I do that, can I just encourage you, please, to like the post and subscribe to our shows. We do really benefit from people liking the shows and spreading the word. It's one of the ways to get the YouTube algorithm to work in our favour. And interestingly, some of the stuff that we talk about is not actually favoured by YouTube because it tends to be not so bullishly ebullient as some. So that's just one of the things. So please like the show. So let's just go back to the top. Dylan asked an interesting question. Haven't watched one of these for a while. Honest question. Not loaded. Yeah. Is the audience now mostly anti-vax or lockdown? Genuinely curious. I don't know. I haven't asked the question. So if that's to people, if they want to volunteer to share a thought on that, happy to, but I'm not going to get into a detailed discussion about that. Okay. Cookie Boy asked about commercial real estate. There was some commercial real estate data in the APRA data. I'm not going to cover it in this show tonight because there's a lot of interesting information coming out from it. I will do a separate show on the commercial real estate sector. Frankly, the short term is actually pretty bad. Very good. And somebody asked about my setup. Is it COVID safe? Well, I hope so. Okay. And he says, another good evening with Martin. Mainstream media agenda free. Absolutely. There's no agenda here. I'm just sharing information. Okay. Umesh asked this question. What is to stop Fed from burning pristine US government treasuries and holding it? And the point is, of course, they can go on doing it. You've got to understand that this quantitative easing lark, it's not real, right? Because what they're actually doing is lifting one side, transferring it across, which means it's on the other side, right? And it's just sort of balancing out. So in the UK, the amount of government debt that the Bank of England has is now as high as it's ever been, and they'll go higher. It's not actually, in fact, impacting anything else. It's just sort of, getting bigger. And whilst a lot of people saying, well, hang on a moment, aren't you creating more dollars or pounds or whatever it is, and isn't that inflationary? The answer is no, not necessarily. Not if it doesn't hit the real economy. Not if, in fact, what you're doing is just making a round trip between the Treasury Department and the Bank of England or, the Reserve Bank. Remember, the Reserve Bank is owned by the government. So it's moving money from one arm of government to another arm of government. So it's actually funny money. And there is no limit to how much they can do that. And my own view is most of the central banks will just go on doing it. And the talk about really turning the volume right down and lifting interest rates is a theoretical conversation. It probably won't happen. At least not for a long time. There's no example anywhere around the world where a central bank has been able to reverse quantitative easing. Look at Japan. They've been the longest. They own the biggest proportion of the Japanese economy, and they're still doing it. Now, Bondi Steve says, banks asking for more money. Yeah, that's right. Well, they'll be tapping on the Treasury door again and asking for a bit more, or, maybe they'll do more term funding facilities like they did previously. Most of that, of course, just went to the banks, and then the banks passed it on to their shareholders, about 4 basis points in the case of CBA. So in other words, taxpayers are actually subsidising bank shareholders. How fair is that? Okay. Cookie Boy says inflation is here, RBA and ABS refuse to admit it. Yeah, well, as I said earlier on, the real inflation, the real lived experience of inflation is a lot higher than the official numbers, but there's lots of reasons why they are actually not reflecting the true measure of things. Not least property prices, of course, are not translated directly in the inflation. There's a sort of a rental proxy which is used, but it's not really very accurate. There are lots of other categories that are actually distorted relative to the real spend of many households. And then you've got other factors like, for example, some of the fuel prices, which are very high at the moment, hitting very hard. And of course, the other side of the equation is inflation going up, but income not going up. And that's what you've got this pincher movement going on at the moment. That's why the stress levels are so high, particularly when income is being compressed because people are working less hours as well. That's something else that I saw in the surveys in spades this time. And he asked whether the Evergrande thing is the start of something big. It could be. The question you've got to ask yourself is whether, in fact, China is going to tilt over. In other words, will they allow more of this to happen? Because they are trying to direct the economy into a different direction. I discussed this with Tarek Brooker last Friday on our Friday afternoon show. And it's very interesting that they are I think serious this time about trying to make some changes. Whether they'll be successful or whether they'll roll over again is the big question, because if they are successful, then I wouldn't be surprised to see more company failures. But the question is, will China allow companies to fail or not? And Nessa asked about negative interest rates. Are Aussie banks ready for negative interest rates? So they've been told to get ready by APRA. The last thing APRA said was, we don't expect negative interest rates to come, but you should prepare for it. And they've been given a few months to basically work out how to prepare for it. Now, there are all sorts of ways of preparing for it. For example, you can not actually have a negative interest rate on your main computer system. You could actually do it by way of fees instead. So some banks are looking at that. We know that in Europe, there are more negative interest rates emerging. And given what we're seeing with the economy's sluggish behaviour, remember how much money's been thrown into the economy? And remember how little we've got back for it in terms of momentum and growth? So yeah, negative interest rates could well be on the cards. The question only is whether they will do negative interest rates before they introduce a digital currency, because if they don't, people will just pull money out of the bank and hold cash, and that will defeat the object of the exercise. So watch this space. I wouldn't be surprised to see something happening there down the track. But yeah, certainly Aussie banks are preparing, and they've been told to prepare by APRA, and we'll see how that plays out ahead. Yeah, and Craig does make the point. There will be some ripples if they don't get some state support. Absolutely. Question is, do they want to set a precedent? Do they really want to bail it out, or will they break it up? My feeling is they'll probably break it up and they'll allow part of it to fail and part of it not. Okay. So, Perry News had the LVR shifting sands. Yeah, well, it's interesting, the LVR story. Very interesting to look at New Zealand. So they've been tightening the screws there because they had this massive housing bubble, and the Reserve Bank of New Zealand admitted that housing momentum was unsustainable and the risks were building. So they've started to intervene, and the intervention has started to take the form of LVR and now potentially other metrics too. But there's a political stoush going on because, of course, the Reserve Bank of New Zealand was given a mandate to think about home price dynamics as part of their monetary policy and the impacts of their monetary policy, whereas here neither APRA nor the Reserve Bank has any interest in commenting on or even impacting house prices at all. They don't see it as their job. They don't think they're responsible for it, despite the fact that the main reason house prices are so high is because of debt. And the amount of debt in the system is what's driving prices a lot higher. But no, none of those regulators, none of the Reserve Bank people are willing to admit that, which I find amazing, but not surprising. And Cookie Boy says, wages growth very bullish. Well, maybe. Mortgage slave for life, that's more like it. Interestingly, the average duration now of a mortgage in Australia has moved up from 25 to 35 years, picking new ones. So that's one of the tricks that they've used to extend the life of the mortgage. And then, of course, if you've actually had a holiday of repayments, you've just had your mortgage extended even further. In Japan, they've got intergenerational mortgages, and you just get to the point where the mortgage is never going to be repaid. In fact, don't even think about trying to repay it. It's always going to be there. You're always going to be servicing that mortgage until you finally fall off the perch. And of course, in a way, that's what the banks want, because the banks benefit from the cash flows of people servicing their mortgages. They actually don't want you to pay it down. They don't want you to pay it off, right? They want you to be, as Cookie says, mortgage slave for life. And of course, as more people commit more of their income to servicing the mortgage, they have less to spend on other things. And the net bottom line is that effectively more and more of the economy becomes orientated to this servicing of debt. It's a fundamental philosophical point about neoliberalism. And, an analogy I sometimes use, it's a bit like having a football match without a referee, right? Just let the free market rip. Nobody will cheat. No one will actually do anything other than look after, their own interests. That's what's happening under the neoliberalism philosophy, right? And the debt levels that we've got and the high levels of mortgage leverage are a consequence of policies that are actually deliberately engineered to benefit, big financial firms through cash flow, but mortgage slaves for life is the net sum of the game. Cookie Boy is active tonight. Do you think we are locked down before the 30th of December? Who knows? There will probably be some freedoms, because I think that in a couple of the major states, they've got to the point where they have got to do something. But that doesn't mean that the virus will be under control. Look at the UK. So the UK came out of lockdowns. They've got climbing rates. They're now talking about potentially having another mini lockdown in the October timeframe around the half-term holidays of the UK to try and actually use it as a, quote, circuit breaker, because they've got the cases running too hot, and they're concerned now about how many of those cases end up in hospital, because it comes back fundamentally not to just the number of infections, but how many are actually being able to be supported by the hospital system, or whether the hospital system will actually run out of capacity. So that becomes the critical throttle point. If we see another throttle point like that, the lockdowns may well not be disappearing, because those are the critical test points in my view. Flocky says we need a royal inquiry. A royal inquiry into what? Into the banking system, into the finance system, into the property sector? I actually think we need an inquiry into what's going on with the RBA. That's the critical thing that should be looked at. And interestingly, I mentioned some weeks ago the report that was done in the UK by the House of Lords looking at quantitative easing from the Bank of England. And they concluded that the Bank of England didn't know what they were doing. And the main reason why quantitative easing was there was to keep debt interest rates down for government debt. Wasn't really hitting the main economy. There will be further discussions on that report in the Houses of Parliament subsequent. And I think there's a very important thing that we should discuss here, which is what is the role of the Reserve Bank? Why have they played the role that they have over the last 15, 20 years? And what's their relationship with Treasury? Because, of course, in theory, the Reserve Bank is meant to be independent. In practice, under the Council of Financial Regulators, they sit around the table with the Treasury, APRA, ASIC and some other hangers-on. So they are effectively in the tent, all in the same tent, all thinking the same stuff, all being fed the same neoliberalism as a philosophy. So it's not surprising they get the outcomes they get. Doesn't help us necessarily to get to where we need to get to. If you want more about that, listen to my rant from the other day. Okay. So Jonathan asked, does your mortgage stress measures take into account temporary cash flow, such as mandatory parental leave? How would the small lockdown baby boom affect household financial stress? Yeah, I try to get, as best I can, the current state of households with all of the ups and all of the downs. It's quite difficult because, of course, things are moving around a lot. Where there is new stuff coming in, I pick it up in the surveys. It's done every week, and we update the modelling accordingly. So, yeah, we do try to take account of all of those variations. Of course, it's difficult because there are state differences this time with what money's coming into to what pocket from what source. So it is quite complicated, but yeah, I do try to cover all of those. Okay, Cookie Boy says, smash the like button. Please do like this show. Very important that you do. Dylan says, you're not going to see a broad fall in Aussie property values. Literally everyone in this Anglosphere and everyone else wants to migrate here. That's true. Migration will definitely be stronger. I discussed this the other day. Again, migration will be the lever that's pulled to try and pull us out of the mire when it comes to growth. It's been that way for a decade plus. We have a lot of spare property though, and more property being built, so it may not solve the entire problem. Cookie Boy says, most postcodes in stress are those with a high migrant influx. Yep, that's true. A lot of people, first generation migrants, and then buying. A lot of people moving to those high growth corridors. I keep talking about those high growth corridors because that's the key to understanding a lot of this. And then, of course, there's an on-flow effect into other areas. Plus, those high occupancy, high rise areas close into the centre of town where, of course, everything's gone pear-shaped. There are a lot of vacancies. Zach asked a very good question. How are the SMEs going with your data? There's a lot of zombie SMEs. Have you seen anything activity due to businesses in stress? Yep. So I do run separately a series of surveys on SMEs. I might well make a show separately about that because there's a lot of data. But basically, there's a lot of SMEs, particularly smaller SMEs, who have no cash flow support at the moment or very limited cash flow support. The JobKeeper last time around sort of helped many. Well, this time it's helping them much less effectively. And so there are a lot of businesses who basically are saying, if this goes on much longer, we are out. And it's a question of how long they survive, how long it is before it all works through. There were some changes made to the Bankruptcy Acts quite recently, which gives a bit more latitude to small businesses. But nevertheless, eventually, it is going to be something which I think is going to hit very hard. And remember, a lot of those SMEs have a mortgage on their home property, which is supporting their business. And that correlation between the SME momentum or lack of it and mortgage pain is something I'm seeing in spades. Jason, thank you very much for your contribution, and you've conveniently asked about a postcode 3233 because we do of course have our postcode engine online, so that's a great segue into our postcode engine. Let me just bring that up. Okay, there you go. So just for those of you who may not have come across this before, we do offer access to a portal of information which is based off our surveys. And this particular view I've got here is a bit of a special view that has been built for me to allow me to present information about a particular postcode and look at it both in terms of the stress data and also the forward projection. So let's look at Apollo Bay, which is 323. I can't see it. There it is. 3233. 3233. That's not right. 3233. Why isn't that working? It's very interesting. Let me just try another one. 3000 is working. Yeah, so that's A P Apollo. Yeah. I've only got 7150 for Apollo bait. No, I don't know. Jason, you might just want to check that postcode. I'm not sure whether that's my end or your end, but let me just try again. 3233. No result found. Okay, don't know about that. Don't know. Should be there. There's no simple way for me to check. So we'll have to look. I'll have to take that offline and do a bit of background research if necessary. But thank you for the contribution, and I will try and come back to you with an answer on that one. Let's go back to this for a second. Cookie Boy made an interesting one again. A lot of people doing 2 or 3 jobs. Yeah, there are a lot of people with fragmented work. I'm seeing this in spades at the moment. Lots and lots and lots of people are actually struggling and therefore doing any jobs they can, a few hours here, a few hours there, etc. Another reason, of course, why people are much more mobile in those areas, particularly where the COVID is raging. So it all is linked, unfortunately. Apollo Bay should have high rental stress. Yeah, just understand why I can't find it. I can normally search by postcode, state or region. You see, I only have that one, which isn't the right one, so I don't know. Okay, I can't answer that at the moment. Another one from Cookie Boy. Big T mentioned this a few times on your show. Property market close to buyer exhaustion. Notice in particular WA, SA and Queensland, a lot of stressed sales, reduced and urgent. Yeah, absolutely. There's a lot going on in WA. There's a lot of nonsense being spoken about WA being booming. There's a lot of postcodes where they're not. Same also in some of those other areas too. And interestingly, I've got Tony LeCantre coming back on next month. So you'll be able to pick his brains directly on that. But yeah, there is a lot of issues where people have not seen the growth that they expected they were going to get and are continuing to struggle. Now, Flocky made an interesting point. Some of those mortgage stress suburbs are breaking through with high sales. Yeah, so there's a few things going on. Some people being forced to sell. Very interestingly, the bank quite often will say to people, you've got some real issues with your finances. It's not going to actually get cured anytime soon. Why don't you put your property on the market, sell before you actually get into difficulty? That's the story. So quite often what you find is that people are actually selling into, well, in some cases, a sort of a more boomy market than previously. But they're being encouraged, and it basically stops the bank having to foreclose so that the foreclosure numbers can stay really low. And it also allows people to get out with their shirt, particularly if prices are actually still moving up. And they are in some of those areas. But, of course, the argument I would have is that eventually the amount of mortgage stress in the system is such that things tend to go pear-shaped after that. Now, let me just come back to Victoria 3000. This is quite an interesting example of what we're seeing in a particular area, and I'll just go through some of the figures so you get a sense. So you have a bit of a map going on here, and then you've got the number of households in the particular postcode, how many are borrowing, so with a mortgage, how many are renting, so you can see 18,000 are renting, and how many properties are for rent, so there are multi-occupancy, of course, there quite often, and the number of rental property owners, so they're the property investors, and then the overall financial stress metric. So that gives you a sense of how much pain there is in this particular postcode. So that's a top level one. Then it breaks out into mortgage stress. So those who are borrowing, 475 are actually in stress. which is 16%. There's a bit of default, but not high. But you've got a very high area of rental stress, 78%, at 14,500. And you've got some stressed investors as well. And quite often rental stress and investor stress go together, because by definition, if your rental payers are actually in difficulty, as an investor, you've got a problem. And then the final point is, I then have some suggestions based on our three scenarios: the more bullish case, a more neutral case, and a bearish case as to what might happen to prices in terms of houses and units in the area. And you can see here that essentially in my bullish case over 3 years there's upside. It's not quite so much upside for units, but on the bearish cases there's a bit of a fall, not a dramatic fall, or if things go really bad then they're down 10% or 8%. So that gives you a bit of a flavour of the way that this works, and you can basically get this for every single postcode that we cover. Now there are a few small ones that don't pop up every month, but as you saw earlier on, like Apollo Bay, if that postcode was correct. But nevertheless, the data is quite rich, and then of course that allows people to make some interesting comparisons. Now you can actually do a few other interesting things, like you can compare different postcodes, so you can put multiple postcodes in and compare different projections, for example. And you can also look at the stress data in more detail, and I'll just put 2000 in now for Sydney. So that gives you the historic stress trends. Let's just go and make that slightly bigger. There you go. So you can see there that the movements in stress over time are quite interesting as well. So that's something else that's in the data as well. That information is available, and I'll talk about that a bit more later, but basically anybody can subscribe and get all this information, access to this portal. It's updated every month, and it pretty much covers all postcodes in the country. With that, let me just see whether there are any other postcodes that people want me to look at, because if there are, I'm very happy to. Let's have a look. Any stats on defaulting on loans? Yeah, I do have stats on defaulting on loans. I haven't put them in the data I've got here today. I may well do a special show on that, because in fact I'm doing an interview tomorrow with Channel 9, because they are interested specifically in the question of defaults and where those defaults are happening. So watch out for that show. It'll be predominantly talking about the Sydney market, but I've developed the model there for the whole of Australia. So I'll probably make a show later on going through some of the same statistics, but on defaults rather than on stress, because defaults is quite interesting. Of course, a lot lower, a lot smaller number, but nevertheless significant. This one from NEB, thank you very much for the super chat. So you want to look at 6035 yen chip. All right, let's have a look. 6035. Oh dear, come on. So 35 yen chip. Yep, yen chip's there. Okay. I'm just going to do the stress first. This is actually using the stress series, and you can see there that the overall financial stress is at 62%. 3,500 households, of which 2,100 are borrowing. Easier if I put that up, wouldn't it? Let me just do that. Go back to this one. Just give me a second. I'll put everything up on one picture. There you go. Okay. You can now see. Okay. So, yen chip, 3,500 households, of which 2,100 borrowing, 1,400 renting, 1,000 for rent, and about 700 property owners. 46% in financial stress, 59% in mortgage stress, and 8% defaults. 17% in rental stress, and 22% in investor stress. So 46%, it's anything over 40, I get worried in financial stress, but a lot of it's mortgage stress. A lot of people with mortgages have some difficulty. And in terms of the price movements, my bullish case is about a 9% rise over 3 years for houses and 7% for units. My bearish is down 8% for houses and 6% for units. So it's somewhere in that envelope. Definitely some upside, but of course the level of the upside depends on all the factors that we touched on earlier. So there you go. Okay. Mike Hunt asks, will Queensland Evergrande price? Well, there are some movements in price, but not dramatic so. Now, in fact, next week we will have a specialist to talk about Queensland property. So watch out for that. That'll be specifically devoted to trying to understand more about what's going on, because a lot of people are looking at Queensland thinking, is it a good time to buy in Queensland? Even sight unseen. So Megan Wells will be joining me, and we'll be having a deep dive into Brisbane property next week. So we'll be able to look at that in more detail. Okay, now there's one from Lee. Fraser Rise 3336. Fraser Rise 3336. Let's see whether I can make that one work. I'm going to put this in first. I don't know whether this doesn't want to do Melbourne. Just checking that one. FRASER. I've got Fraser Island, and I've got Fraser Range, and I've got Fraser, but I can't find the one you're talking about. So I can't help you on that one, sorry. Maybe there's a postcode with a small number of households, just to explain that my survey is statistically optimized across the country, but it focuses more in on the big postcodes with big numbers, and that means that some of the small postcodes can drop off because it's just statistically too small to be caught every time. But again, check your postcode. If it's right, I'll try and check it up afterwards. I've got one here from Stripey Cat. What was that one? Stripey Cat said 7021. Let's try that one. 7021. Which is in Lauderdale in Tasmania. Let's put that there so we can see it, and then put that up there, and then get rid of that. Right, here we are. So just over 1,000 households, 500 and something borrowing, 268 renting, and 70% in financial stress. So the stress levels are quite low, but it's all in mortgage stress. So 33%, 1/3 of those borrowing are actually having some difficulty with their mortgages, and default rates are about 3%. But there's no rental stress or investor stress in the area at the moment. And we're looking potentially over the next 3 years of the bearish end of it, 11% for houses and 8% for units. The bearish case is down 6 or down 4. So hopefully that gives you a bit of a flavour of what I see. Fremantle. Now, can I do Fremantle without the postcode? You see, a lot of it requires Fremantle. There we go. Bingo. It worked. Yep. So this is for Mr. Submariner 76, Fremantle. Okay, so 4,600 households, 1,100 borrowing, 2,700 renting, just over 2,000 properties for rent, and about 1,000 investors, 41% in financial stress. Mortgage stress is 67%, and Some of those, half or so, are in severe stress. Now, severe stress means that they are deeply underwater. So you've got a lot of people there who are in some financial difficulty as a result. The rental stress is at 29%, 794, and the investor stress is at 31%, 315. And in terms of projections, well, we're thinking next 3 years, maybe on the bullish side at 8-9% for houses, or 5 to 6% for units. On the bearish case, down 9% and down 6%. That's the way I see it at the moment. And, they're just estimates based on the current data. It will move around, of course. It's just a matter of how it varies. Things change all the time. Here's another question somebody has asked me. Tom White, 4121. Let's try that, shall we? 4121. 4121. Okay. 4121. There you go. So we've got 9,700 households, 4,500 borrowing, 3,700 renting, 2,800 properties for rent, and 3,700 rental property owners, 37% in financial stress. Mortgage stress is at 26%, which is 1,158. Rental stress is at 41%, 1,560. And investor stress is at 23%, 879. So rental stress is the problem. And growth rate of 14% over the next 3 years for houses and 10% for units, or bearish case around 3% down or around 2% down. There you go. And Mike Hunt says, get Robbie back on. Yep, he's coming on. In fact, in 2 weeks' time. So watch out for that. Be an interesting conversation. Okay, this very interesting question from Theo, which, whoops. Why is the Australian dollar so high? Good question. Well, is it? It is quite high. So we've got this situation where central banks around the world are all doing quantitative easing. They're all chasing each other. They're all basically trying to keep their currencies roughly in a similar position. Of course, our dollar reacts very strongly to what's happening with the US dollar. The US dollar is actually quite high. Some of the more recent information from the US probably weakened the US dollar a little bit, and that's brought our dollar a little higher. The real interesting question is what happens as the iron ore price goes south. That could definitely drive the Aussie dollar down. On the other hand, the very low interest rates and the very active support from the government and from the Reserve Bank is also supporting the Aussie dollar. But the Reserve Bank would love to see the Aussie dollar lower. Ideally for some, maybe 50, 55, I think, rather than 70 something. So it's way too high for that because, of course, it makes us less competitive. But is this because of the international stuff that's going on with all the quantitative easing and all those things? So there's a limit to what we can do locally to try and move the dollar. And the other point is that Australia is still regarded internationally as a relatively safe haven from a finance perspective. A lot of money is flowing in, and that's also supporting the dollar too. Okay, now I've missed over quite a few. Let's have a look. Very interesting question from Jonathan. What matters more, absolute numbers of mortgage or the relative proportion? I actually have both sets of data, and I chose today to go with the big numbers because I think the big numbers tell a really important story. Because, of course, you could have a very small postcode with quite a high proportion of people in mortgage stress, but it wouldn't necessarily move the needle. It would be a local problem rather than a national problem. Whereas if you've got thousands and thousands of households in particular areas, then they tend to have a more significant factor. And there is also some correlation. So some months I do percentages, some months I do counts. Sometimes I put them both up. So I look at both. Okay, Shani is 2281. Whoops, 2281. Let's put that up. 2281. Okay, 2281. Switch that across to there. Get rid of that so you can see it. All right, so this is Catherine Hill Bay, Swansea, Nords Wharf, Middle Camp, Caves Beach, 6,500 households, 2,100 borrowing, 2,300 renting, 1,700 properties for rent, and 2,200 rental property owners, 42% in financial stress, 43% in mortgage stress, 903, 57% in rental stress, so rental stress is the problem, and some investor stress. And in terms of projections ahead, well, we're looking at about 6% price rise for houses next 3 years, or worst case, down 11%, or 4%, and down 8% for units. Okay, now what else have we got going on? Ben asked, 3180. And of course what happens is I get way too many requests towards the end of the show for me to actually answer them all. 3180, Knoxfield I should say, 2,941 in household count, borrowing 1,300, renting 919, properties for rent 698, 39% in financial stress. Looking at mortgage stress, 663 in mortgage stress, or 50%. Of default, not dramatically so. Half of renters are in difficulty, and a small proportion of investors, 8%. And projections, we're looking at 9% over 3 years for the bullish case, I should say, for houses, or 6% for units. Bearish is down 8 or down 6. So there you go. What's the time? 9:23. Wow, we're definitely running against the clock. Okay, what's that one? Brett asked a very important question. Any thoughts on the social impact of mortgage and rental stress? And thanks for the super chat as well, by the way. I'm seeing more and more families price out of their areas living in cars. Yep. So there's a few things going on. People are being forced to look further away or in different areas, or as you say, live with family. So we're seeing more multi-generational occupancy than we saw previously. We're also seeing a lot of people struggling with multiple work, multiple jobs I discussed earlier on. But if I take an example locally down here in the Illawarra where I am, we're now seeing locals being priced out. They cannot afford to buy because people with money from Sydney, it's coming down into the Illawarra and buying up all the property. Prices have gone up dramatically. So what they're having to do is look further down the coast, the other side of Wollongong, for example, or in areas much further away from where they would want to be, or club together to try and buy together, which is, I'm also seeing some of that, or just giving up and, as you say, compromising in some other way. So it's a real big issue. And I keep talking about the social consequences of all these things, right? Because there are massive implications of people up against it, people with financial pressures, people with societal issues. And quite often what I see following is a rise in crime, a rise in social disruption and disharmony in the particular areas. So it tends to follow. And if you wanted a case study of that, and I'm sorry to pick on Mandurah again, but I'm going to look at Mandurah. So Mandurah went through a significant property rise a decade or so ago. Prices came way back. And since then, the social consequences of that are there on the ground today. You can see it, and there are lots of issues with crime and other things there. So there are real consequences for real people. And, go back to my neoliberal growl earlier on. Neoliberalism doesn't take account of the social consequences of what they do, because they only think of it in market terms. They only think of it in terms of the value that's being created and the cash flow that's being created, not the social consequences. And my belief is that we need a different way of thinking about this that really does better think through the social consequences of what's going on. But that's politically, of course, very difficult in the current environment. What else have we got then? Paul said 4314. It was wrong last time. So was that one that didn't come in right? Yeah. 4314. Let's see whether it comes in. No. 4314. It looks like that could be another one that's not on the list. So apologies for that. I don't think I swore, did I? Cookie boy? What did I say? I'll have to listen to the replay. Amanda says, could you look at Coalac 3250? I'll have a go. Whoops. 3250. Coalac, yeah, that's there. There we go. Okay, let's just put that up and get rid of that. This is Coalac. 5,600 households, 1,900 borrowing, 2,200 renting, 1,700 properties for rent, 39% in financial stress, 8% in mortgage stress, so mortgage isn't really the issue, but rental stress is 62%, 1,122. And as a result of that, property investors are also in difficulty, 43%. And prices up 9% over 3 years for houses, 7% for units. That's the best case, or down 8%, down 6% over 3 years. So there you go. Well, we've hit 928. I'm just going to do a couple more. 3844. See whether that one comes up, shall we? 3844. Yep, it's coming up. There we go, 3844. I will, for those that didn't manage to get the information tonight and you still want stress information, if you contact me via the DFA blog, I will, over the next few days, send you this one-page picture if you'd like it, or indeed you can sign up and get the full data set, which I'll talk about in a second before I close out the show. Okay, 3844, 12,900 households, 5,400 borrowing, 5,000 renting, 3,900 properties for rent, and 44% in financial stress, 60% in mild mortgage stress, bit of default, not a lot, 39% in rental stress and 19% investor stress. So it's really a mortgage stress question. Price 9% higher over 3 years for houses, best case, or down 8%. For units, up 6% or down 6%. So there you go. Now, what else have I not done? Let's try for one from Jason, just out of curiosity. 4877. Yeah, I think you're right about the long-term rentals, because of course a lot of that is being done through Airbnb. And Airbnb, interestingly, in some areas in the UK, they're now talking about banning Airbnb or putting specific conditions on Airbnb, particularly in some holiday areas, because locals are being completely priced out of the market. So there you go, Port Douglas. There we go, 4877. 3,100 households, 669 borrowing, 1,900 renting. So yeah, a lot of rentals there. A lot of properties for rent as well. And there's around 730 rental property owners. Financial stress is pretty low at 12%. No mortgage stress to speak of. Some rental stress at 12%. Some investor stress at 20%. But not dramatic. But look at this, 16% over 3 years. Upside, best case scenario. Downside scenario just below zero for houses. Up 12%. Or just down slightly. So, Queensland, particularly this area of Queensland, is looking pretty hot. But no long-term rentals indeed is part of the issue, I think, in a number of areas there. What else have we got? Really appreciate your contribution. Oliver, thank you very much. Greatly appreciated. Now, I just want to see whether I've missed anything in terms of... Let's have a look. I think I've got them all. Okay. Good. Right, well, I'm just going to come back and finish the end of the presentation. I might do a couple more postcodes after I've just finished off so that people can drop off if they want, bearing in mind we're at 9:32 already. As with all of these things, there's plenty of things to talk about, of course, but sometimes we can't necessarily cover everything on one show. All right, so let me just put this back up. So this is just picking up the conversation from earlier on. This is 3 slides I found from Bloomberg, which I thought was really interesting. So they were arguing that if you look now, something has changed, and essentially growth is back. So value and the reflation trade are in retreat, and this is comparing the Russell growth over the Russell value index. So they're arguing that something has changed in the markets. If that is true, that's significant because, of course, there was a very significant move to what's called the reflation trade. When everyone's betting on inflation being very high, that could be changing. If that has changed, that could change the markets dramatically. And it's quite interesting that I think that of all the factors that are there, it seems to me that that's a very important factor in terms of trying to decode what the what's going on in the markets. Because the markets, I think, are in pretty twitchy mode at the moment. My own view is there's going to be probably more ructions over the next month or two. And just to sort of give you a context on that, this is the US employment, again from Bloomberg. Fascinating to see that the employment rate, which is at 58 and a bit, is still significantly down from where it was before the pandemic. And it's actually where it was in the 1980s. So we don't have much in the way of forward momentum from there. So it's another indication that things are not as powerfully positioned as many were thinking. And interestingly, Asia and European markets actually didn't react negatively to the US employment report, despite the fact it was appalling. The all-world FTSE, excluding the United States, it shows that it was actually quite strong. So that's quite interesting. I think there's a lot to play for. I think the markets are going to be very wobbly over the next little while. And frankly, that is something which I think will haunt us over the next couple of months. So it'll be good to get Tony's view later on in October. And I'll be tracking that as we go. Now, just to finish off, if you want more information about what we do, you can go to walktheworld.com.au, and that includes our funds run by Nucleus Wealth. They've performed really well, actually, over the last little while. So if you need help in terms of investing, the Walk the World funds are there, and you can get more information. You can also go to the DFA blog. You can sign up and get all alerts for all that we do. A lot of posts done every day there. And you can also support our work via Patreon, different levels. But the one I want to highlight is just the stress data of US $50 a month. Gets you access to the portal that I've been using tonight and allows you to download all the data and make comparisons and all sorts of other things. It's a very powerful tool if you're interested in property, and we update the data every month. And we have quite a few people who subscribe directly and get direct access to that portal, and it's live and accessible all the time. You can also make a contribution via PayPal if you'd like to help support our work. We do this because we think it's important rather than because we want to make money off it, but it does help to cover the costs. Or indeed, if you want to make a Bitcoin contribution, that's also conceivably possible too. Or there's Merch as well, which I don't really push very hard, but it's just there if people want it. Have some people buy. And next week, Megan Wells, as I mentioned earlier on, is coming on to talk about Brisbane and Queensland property. And the question that I've really got there is, in the light of all the interstate migration and all the stuff that's going on in terms of people buying sight unseen, what's the story? What's the real story on the ground? So that'll be worth, I think, spending some time on next week. So mark your diary and join us there. And with that, let me just go back to the main... okay. I'm going to do a couple more postcodes just before I finalise the show tonight. And to do that, I just need to go back to there so that I can get that up on the screen. Playing with lots of different mice at the same time here, which is quite fun. Okay, 2541, 2541, Naura. Okay, so this is from Mars. 2541. 11,400. Get rid of that. 11,400 households, 3,500 borrowing, 5,500 renting, 4,200 properties for rent, 4,600 rental property owners, 42% in financial stress, very low levels of mortgage stress at 4%, 60% though in rental stress, and that's we're seeing in a number of these areas south of Wollongong, very high levels of rental stress, 60%, 3,300, and 38% of investors struggling. Prices, 7% over 3 years, best case, or down 10%, worst case for houses, and up 5 or down 7 for units. There you go. And Simon asked for... There we go. 3765. I see a few people signing off, so good evening and good night for those leaving. And I'll be off in just a few moments, but I'm just going to do a couple more. 3765. I think perhaps what I should do on a show is just do postcode lookups. Maybe I'll do a special show. That may help. 3765, there we go. So that's Montrose, 2,400 households, 1,400 borrowing, 577 renting, 57% in financial stress, 60% in mortgage stress, 881, rental stress is at 80%, investor stress is at 15%. So rental stress is the issue. Price movements up 7 over 3 years, best case or down 10 for houses, up 5 or down 7 for units. Okay, there you go. Well, I think that is as much as I'm going to do tonight. Now, if you have not been able to get your postcode up and looked up, send me a message via the DFA blog, details in the comments below, and over the next few days I'll process that and send it back to you. Or subscribe to get all the information. Vanessa, cheerio. Thanks for your support as always. Great to see you, and see you next week. Mars says, "You're a good honest man." Thank you. I try to be. I don't sort of, bullshit. I just give you the information because I think that's what people need. Mike says, "Thanks." Long time listener, first time caller. Hi there. So Happy says, "Don't show stress to 2 decimal places." Yeah, interesting question. I think generally we don't. Donna says, high-level investors immigration visa at the moment. Hotel quarantine numbers seem to be a lot higher than the degrees. Is the number of Australians returning home. Yeah, watch the migration. I did a show on that the other week. Absolutely agree with that. Absolutely agree. Okay, so with that, I think we're done. And I want to say thank you all very much for spending some time with me this evening. I hope you found that useful. I will just end as I always do when I talk about mortgage stress. It's really important for people to understand their financial profile, think about their cash flow, understand what money's coming in, what money's going out. Half of the people in my service have no idea. We have to sort of take them through a process to be able to understand where they are. Once you know what your financial profile looks like, and by the way, ASIC has on its smart money site some really good planning tools there. You can then prioritize and select Second point is, if you have pressure on your mortgage, talk to the bank, but also make sure you've got the very best rate you can get, because a lot of people are locked into higher rates. And so there's a way of saving some money there. I made a show on that quite recently. Third, again, if you are in financial stress and difficulty, reach out early, and you can talk to your bank if you've got a mortgage, or talk to some financial counsellors, or there are people who can provide advice free. I'd also counsel against going to these people who claim to be able to restructure your finances and solve your debt problems. Those debt counsellors, particularly if they start charging for it, are actually a bit of a scam, because they take a lot of money and they do things that you could do yourself. But there are also some people who actually do provide real help and real support, and it's, I think, important to be careful about who you talk with. So that's just some thoughts there in closing. Thank you very much for spending some time with me this evening. Hope you've enjoyed it. Hope you found it useful, and look forward to seeing you next week when we'll explore Brisbane property. This is Martin North from Digital Finance Analytics, signing off. Cheerio.